Lately, we've been hearing mixed reviews and disappointments about Schwab USA. Dividend Stock ETF, NYCRCA SCHD, is one of the most popular and best-managed dividend growth ETFs on the market. I wrote several articles about SCHD in Q3 2023 and Q4 2023, Editor's Choice. We highlight its struggles with dividend growth over the last year, resulting in a 3.77% increase, while preserving its unbroken dividend growth record. I think this battle will continue into 2024, but the focus is now on stock price increases. Many investors are frustrated that SCHD's stock performance has been stagnant for 3 years, while the S&P 500 index has soared recently. Although the two indexes are different from each other, investors expect some correlation since the SCHD beta is 0.91. Investors typically always compare benchmarks, such as the S&P 500, to determine whether their investments were a wise choice. One commonality I see is that SCHD has never been tested outside of a bull market since 2011, and investors have been fooled. That's not true. In this article, I'd like to look back at the historical data and current economic factors that led me to continue purchasing SCHD as part of my portfolio's core dividend growth holdings. S&P 500 versus SCHD performance reference timeframes are very important both for performance comparisons and personally invested time. For reference, we have used SPDR S&P 500 ETF Trust, SPY, in place of all comparisons in this section. I believe the following Y chart nicely summarizes the bear's short-term dissatisfaction with his SCHD. The S&P 500's total return is 22% higher than SCHD in just over a year, which is more than 3 times his SCHD's total return of 31.54% versus 9.38%. Y-chart's data, 22%, is essentially his 2-year average performance, and some investors are not confident that SCHD can catch up, but it is possible to catch up. The data below shows several years in which SCHD achieved a total return of over 20% in a single year. In the previous article, Schwab also showed that in his 2013, he had a return of almost 33% in 1 year. SCHD total revenue since inception, Schwab Asset Management. Let's zoom out even further. The S&P 500 has outperformed SCHD by 71% since its creation in 2011. However, if you look closely at the chart, one might argue that SCHD will outperform the S&P 500 in 2022-2023 when total returns were higher. Up to this point, the two indexes have performed very similarly. Data from Y-charts below, we have shortened the period from 2019 to 2024 to 2023 to 2024 to calculate the difference between the total return and price return of SPY and SCHD. To see how big of an impact 2023 had, look at how that difference changes by 2024. There is convergence between the total return and price return of SPY and SCHD. The ranges for 2021 and 2022-2024 were quite similar, with a difference of only about 6%. From 2023 to 2024, we will see a sharp increase in the price differential that determines the current total return differential. It's worth noting that while SPY consistently outperforms SCHD in terms of price return, the difference in total return, including dividends, is often small. This suggests that SCHD's dividend yield partially offsets its relative underperformance in terms of price appreciation. The fact that the difference in total returns between 2023 and 2024 is larger than between 2019 and 2024 strongly suggests a short-term difference, with 2023 and 2024 likely due to faster price increases in the S&P 500. This suggests a significant impact on total returns. The difference between SPY and SCHD returns. Nicholas Brado, Y-charts. History: the dot-com bubble and the Great Recession. An important point about SCHD's long-term performance is that this fund has only been around since his 2011. That's not true. We know how the S&P 500 performed during the dot-com bubble and the Great Recession, but we don't know about SCHD. Although this is technically true, there is a benchmark underlying the fund, the Dow Jones U.S. Stock Index. The Dividend 100 Index is a much longer synthetic SCHD backtest data prior to 2011, from 1999 to 2014, available from S&P Dow Jones indices. From 1999 to 2014, the average annual return for the S&P 500 was 5.41%, while the annual return for the U.S. Dow Jones was 10.38%. Dividend 100 Index. This represents a 5% increase over 15 years, or approximately a 75% increase in total returns for synthetic SCHD. Remember that SPY has outperformed SCHD by 71% since its inception, so we can take a longer view of how these two ETFs can trade off performance over roughly the same time period. While this comparison does not answer all questions about this story, it provides deeper insight and broader information on how SCHD has responded to different market scenarios. Overall, I don't want one of his two funds to significantly outperform the other. I have 100% of my $401,000 invested in the S&P 500. However, I invest in SCHD for income, dividend growth, and NAV stability to offset the emergency fund in my tax liability brokerage account. Data from Y-Charts, inflation. Another important note is inflation compared to SCHD. Inflation rates in the 70s and 80s were similar in 2021 and 2022 at 7.04% and 6.45%, respectively. SCHD total return versus inflation, portfolio visualizer. At first glance, it may appear that SCHD is slowing down with the after effects of inflation, but it will take more time to understand and see the long-term impact on the fund. I think it is necessary. My money goes to dividend stocks, inflation. Going back even further to 1930, dividends contributed to his 40% of the S&P 500's total return. In the 1940s, 1970s, and 1980s, this figure increased to 54% when inflation rates exceeded 5%. In the 1940s and 1970s, inflation peaked at 6% and 7%, respectively, but these numbers rise to 65% and 71%, respectively. I believe that quality dividend stocks can help combat inflation. S&P 500 returns, compared to decades of inflation, Bloomberg Financial. According to Fidelity Investments, on average, dividends have accounted for 41% of market returns since the 1940s. The ratio increased with the rise. During periods of inflation since the 1970s, dividend stocks generally outperformed non-dividend paying stocks.